Good morning. Welcome to Taxation of Commercial Real Estate Transactions. I'm Roger Royse. I'm going to be your presenter today as we go through a broad sort of overview or survey of tax issues that arise in commercial real estate. As you know, I am the founder of the Royse Law Firm, a business, tax, and corporate law firm with offices in Northern and Southern California. Thank you for attending, and those of you that are here have probably noticed over the last few years a certain uptick and increased healthiness in the real estate industry, especially here in California. If we were doing this webinar a few years ago, the topic would probably taxation of distressed properties. But since the market has improved, at least in the commercial world, so substantially, it seemed worthwhile to conduct a survey of all of the tax issues that may come up, or at least a broad summary of the high-level tax issues that come up in the real estate business. And that is what we're going to do today. This webinar is being recorded. You will find it on our resource site, royceuniversity.com. It will also be on YouTube under videos, and will also be available as a podcast in the Apple Store. In addition, the slides will be posted and have already been posted on SlideShare. So plenty of resources, and in fact, you'll find a transcript of the webinar that'll be available this summer on royceuniversity.com. So the topics that I'd like to cover today, we're going to break these down into a handful of broad topics related to commercial real estate. We'll talk about the general, and some of this will be very basic, the general rules regarding sale and exchanges, and some of the themes that run throughout the taxation of real estate transaction, when we have a taxable transaction, how they're taxed. We'll, of course, talk about non-recognition transactions, since a big part of this industry certainly relies on the non-taxability of certain exchanges or sales. We'll go into a little bit about deductions, unique to the real estate business, some tax issues around leases, financing techniques. Of course, we do need to mention a few things about distressed property whenever we talk about real estate, and FIRPTA, foreign ownership, foreign investment in real estate, and at the end, a few tax and estate planning ideas. Those of you who have questions, you'll notice in the right-hand corner of your dialog box of your screen, you'll find a dialog box for questions. Go ahead and type in your questions. If we have time at the end of the webinar, I will go ahead and respond to questions. So starting at the very broadest level, taking a very big chunk here, in the sale or exchange world of real estate, the analysis that we start with is how much gain do we have is the first question. And gain is simply the formula amount realized less adjusted basis. And it gets complicated after that. So amount realized is not only the cash that's received in exchange for real estate, it's not only the fair market value, it's also the liabilities relieved. So for example, if we have a sale of property and we are receiving $100 of cash and property worth $500, and that property is subject to a liability of $200, well, if we add all those up, we have an amount realized, not just $100, not just the $600, but $800 is the amount realized. That's the first step. Step number two is, and by the way, the liabilities relieved includes pre-closed real estate taxes, as well as mortgages that the property may be subject to. Step two in the formula is what's the adjusted basis. That's going to give us our gain. So adjusted basis is the acquisition cost plus or minus adjustments. Adjustments could mean capital expenditures that would increase basis, or depreciation, which would decrease basis. Now, sometimes adjusted basis is not necessarily acquisition cost. There's a concept of substituted basis, and that's basis that's determined by reference to somebody else's basis. For example, in a gift scenario where somebody takes a basis from the donor. There's also the concept of carryover basis, which means that there's a reference to the taxpayer's basis on other property. So for example, if somebody does a like-kind exchange, for property, their basis will carry over. In other words, the basis they had in the exchange property will translate to the property they receive in the exchange. But other than some of those exceptions, typically it's acquisition cost plus or minus adjustments. That gives us our gain. Then the next question we ask is, how much of that gain do we recognize for tax purposes? So the two concepts here to keep in mind, and they're actually very different, are realization and recognition. So gain is typically realized upon a disposition. A transfer of a property may be a realization event. So first we find out if we've got a realization event. For example, a transfer to a partnership would not be a realization event. A transfer by disposition in a sale would. Then the next question is, now that the gain's been realized, is it recognized? Meaning that, is it going to be taxable? For example, a gift, as I said, is not a realization of a gift event. However, a transfer in exchange for another property, for example, a sale leaseback, a conveyance for debt, something like that, that is a recognition event. So if we have a realization and a recognition event, then all of that gain becomes taxable. Next question, what's the character of that gain? Is it capital or ordinary? As everybody knows by now, our capital gains rates have now increased to potentially 20% versus an ordinary income rate, which at the individual level is more than 39%. 35% corporate, the corporations don't qualify for capital gains treatment. But usually for an individual, we're looking at the difference of more than 19% spread, 20 versus 39%. In addition, we now have the 3.8% Medicare surtax on investment income, which applies to real estate gains. And that 3.8% applies to taxpayers who have more than $200,000 of adjusted gross income or $250,000 jointly. So obviously it's a good thing to try to fit within capital gain treatment. Do we have capital gain or ordinary income? Well, do we have a capital asset? Real estate may be a capital asset or it may not be. So for example, capital asset is defined in Code Section 1221 by exclusion. It is not inventory, it is not depreciable trade or business property, it's not accounts receivable. It is typically investment property. And the tension here, and by the way, 1231 assets also apply for capital gain treatment, and that is depreciable trade or business property. So real estate is usually one of the two, capital under 1221 or 1231 property. The difference, the distinction between capital and ordinary in the real estate world usually hinges on the difference between investment property and property held for sale, primarily for sale to customers in the ordinary course of business. Now, when would you have, we call that inventory property. When would real estate be inventory property? Well, it would be a dealer. It would be somebody who engages in sales of real estate on a frequent, continuous basis. And that's a factual determination. The facts that are relevant, of course, first of all, are the volume of the transactions, but also the types of marketing and promotional activities that that person might engage in. So there is a safe harbor that if you're going to practice in the real estate world that people ought to know about under Section 1237, and this applies to sellers of lots or parcels that are part of a tract of real property. And under this special rule, any parcel that's part of a tract is not deemed to be inventory property under this section if it's a qualified tract. Keep in mind this safe harbor does not apply to C corporations, doesn't apply to conversion of apartment units to condominium units. Now, under this safe harbor, there are several requirements that have to be met. First, the taxpayer hasn't held the tract or any lot or parcel in it primarily as inventory property, meaning for sale to customers in the year of sale. Second, in the year that the sale occurs, the taxpayer hasn't held any other real property for sale as inventory property. Third, the taxpayer must not have made any substantial improvement to the tract that enhances the value of the lot that's held for sale. And fourth, they must have held that lot or parcel for at least 5 years unless they acquired it through inheritance. Now, if all of this is true, there's a special tax regime. And under this tax regime is basically if more than 5 lots in that qualified tract are sold, then any gain from a sale that occurs during the year in which the 6th lot is sold is deemed to be inventory property, ordinary income, to the extent of 5% of the sales price. Okay, and the rest is capital gain. That's the 1231 safe harbor that subdividers need to be aware of. I want to say a few words about depreciation recapture, because sometimes people forget about this, but it's important to keep this in mind. So typically, whenever we have a sale of real estate as a capital asset, we also have to look at the depreciation that's inherent in that real estate asset, applicable to the building primarily. Under Code Section 1245, all of the depreciation that's previously been taken on the property is subject to recapture, meaning that it gets recharacterized from capital to ordinary income. Under Section 1250, the depreciation on the realty, buildings for example, gets recharacterized as ordinary to the extent that the depreciation taken exceeds straight line basis. Now there's a special 25% rate on depreciation recapture for real estate, but it's important to always consider recapture whenever there's a sale of real estate that you're trying to fit within a capital gains rate treatment. That's the taxable transaction. The non-taxable transaction, non-recognition. Remember what we said, gain, amount realized, less adjusted basis. Do we have a realization event? Yes. Then is it recognized? So let's assume it's not recognized under the most common one that we're all familiar with, the like-kind exchange. Now, of course, a like-kind exchange is an exception under 1031 of the code from recognition that basically provides that a certain property is exchanged for other property that is like-kind, the gain is not recognized for tax. And in the real estate world, that means real estate for real estate. And it's relatively broadly defined. In other words, you could have land for buildings, you could have improved for unimproved. As long as it's real estate, you could even have a very long-term lease exchange for real estate, and you could fit within like-kind exchange. Almost always, it's the taxpayer that is seeking to fit within that exception and wants to claim that exclusion. Sometimes it's the IRS, and we'll talk about that later, when it's in the interest of the IRS to try to claim like-kind exchange treatment. But number one, it's got to be like-kind property for like-kind. Now, one of the things that's required here is that we either trade up, in other words, that the property be traded, exchanged for property equal, at least in value, to the relinquished property, or greater value. And the reason why is because if that's not the case, then the taxpayer is necessarily going to get something other than like-kind property back in the exchange. And sometimes what they're getting back that is not real property is relief of indebtedness. And that's what we call boot. And a 1031 non-recognition exchange is taxable to the extent of the boot. When we have property that has mortgages on it, we have to net the mortgages to determine how much boot there is. So in other words, if we can trade up, even though we have mortgages on your property, there won't be boot to the extent that we don't have, to the extent that we're trading up and to the extent that we're not being relieved of more mortgage than we're assuming. Okay? So where we have a lot of tension in the non-recognition world, the like-kind world, is it's not very often in my practice that I see a simultaneous exchange where somebody has a piece of property, it has some, whether it has debt or not, that they actually just exchange it for another piece of property. Almost always we do a deferred exchange. In other words, the property will be sold, the proceeds will be parked, then they go out and find another property and we use a third-party intermediary. And I'm going to talk more about that in a minute, but as a prerequisite to that step, oftentimes we have to do a little pre-transaction structuring. And the rule that oftentimes will trip people up is this rule that like-kind property has to be property held for productive use in a trade or business. For example, you would not have a like-kind exchange of your personal residence while you're using it as a residence. Now, the three cases to think about in this case are Volker, Magnuson, and Mason. And then there's our revenue ruling 77-337. And in these cases, the fact pattern is generally that property is held in an entity, it drops out of the entity or up to its shareholders or partners, then the partners exchange the real property for other real property. The IRS has taken a position, in the revenue ruling for example, that that property has not been held for investment, okay, because it was acquired with the idea that it was going to be immediately disposed of. Well, the case law has been much more favorable on this. In the cases, the taxpayers won. Volker in particular has been a very taxpayer-friendly case. That involved a corporate liquidation. Mason involved a partnership drop and swap. Taxpayer wins. Revenue ruling, almost identical facts, taxpayer loses. So it's something that needs to be it's an issue that needs to be understood and needs to be planned into. And I will tell you anecdotally that the tax forms now require people to disclose this, and the Franchise Tax Board in California takes a very close look at this issue. By the way, we don't have this problem if the property is held in a single-member LLC or if it's immediately acquired and then dropped into a single-member LLC as a federal tax matter, because that's treated as a disregarded entity. We do have the issue if the property is dropped, swapped, and then dropped into another entity, because it may not be held post-transaction. So one of the techniques that we often use, especially when we have this drop and swap idea, when the property is held in a partnership, oftentimes we'll find some partners want to exchange, some partners want to cash out. How do we do that? Well, one way is we could liquidate the partnership and let them do their transaction. That raises this 77-337 issue. The more common way is that the partnership itself exchanges in the exchange, but it exchanges down. In other words, it receives cash in the transaction as well as like-kind property, or exchanges into a property of lesser value and takes the cash for the difference. It distributes that cash to the non-exchanging partner, and it allocates all the gain, which theoretically ought to be equal to the amount of cash to that partner. Partner has cash equal to gain or gain equal to cash. Remaining partners have no tax because they've done a like-kind exchange. That is theoretically how it works out. And that is a structure that most of us have gotten comfortable with. There has been some commentary that there's some risk that those allocations in partnership lack substantial economic effect, but most authorities believe that that works just fine, and it's done very frequently. One thing to keep in mind is that in the case of a related party, if property is acquired from a related party, there's a 2-year holding period. So in terms of this holding idea, there's a special holding rule when property is acquired from a related party. There's no hard and fast timeline otherwise. Now, I started to talk about deferred exchanges, so let me finish what I was saying. So I'm going to jump ahead to a slide. Typical deferred exchange transaction, like I say, it's not oftentimes one taxpayer exchanging real property for another taxpayer's real property. Instead, taxpayer sells relinquished property, proceeds go into an escrow account with a qualified intermediary. Qualified intermediary goes out and finds relinquished property, transfers replacement property to buyer. You see it on the chart in front of you. It's really a 3-party transaction, in fact 4, because we've got an intermediary in the middle. That's okay. The regulations expressly sanction that sort of exchange. When that happens, however, we have to meet certain requirements. One is that the qualified intermediary really does have to be independent. We don't want to have that person to be an agent of the seller, because there can be no actual or constructive receipt of the sales proceeds. That goes a little more than just who the intermediary is. It also means that the taxpayer doesn't have the right to pledge, borrow, or obtain the benefits of the exchange proceeds. It can be somewhat subtle sometimes. There must be a written agreement, an exchange agreement. And then the technical requirements that have to be complied with and should be paid attention to are 2 numerical requirements. Number one, a taxpayer has 45 days to identify in writing a limited number or amount of replacement property. Okay, and there are various rules that we won't go into as to how many they can, actually they could identify up to 3 properties. They could identify any number of properties less than 200% of the value of the exchange property, or they can identify any number of properties provided that they close on 95% of them. Secondly, a taxpayer has 180 days to acquire the replacement property, or the date that the taxpayer's income tax return is due, including extensions, whichever is earlier. That's a little bit tricky because everybody thinks 180 days, but if you have an exchange that's after October 18, you have less than 182 days if you file your return by April 15. So it's really the lesser of those 2 time periods. And that is high-level 1031. Now, going back to our non-recognition transactions, the other non-recognition real estate transaction that is very significant in the real estate world has to do with involuntary conversions. And an involuntary conversion basically means a destruction, theft, seizure, condemnation of the property. In those cases, think of it as a compulsory taking of the property as a result of destruction. Now, under 1033, a taxpayer doesn't recognize any gain realized from an involuntary conversion of the property into a property similar or related in service or use. So it's a little bit different definition than like kind, but generally you get the idea that it can be, the proceeds of the conversion are basically rolled into another property. Now, unlike the like kind rules, unimproved real property and improved real property are not similar or related in use. Okay, so you can see it's a little bit different, definition. Now, there's a concept here that there's a qualifying replacement purchase, that's a similar in service or use, during a replacement period, which begins on the date of the disposition of the destroyed property and ends 2 years after the year in which the gain is realized on the converted property. And then there's an additional 1 year for certain types of real estate, and that's real estate held for productive use in a trade or business or for investment. So that is the 1033. I can tell you as a planner, we can plan into a 1031 transaction, but it's awfully hard to plan into a 1033 transaction for obvious reasons. But once you're there, the tax code does provide some relief on gain recognition. Let's talk a little bit about deductions. So, you know, they say that real estate is a game of pennies. And I think what people mean by that is that after-tax numbers go directly to the value of the real estate. When you value real estate, you often hear real estate folks talk about cap values, capitalization, and it really ties directly to how profitable that real estate is on an ongoing basis. And deductions, especially tax deductions, loom large in this environment. So, number one, let's talk about depreciation, because that's probably the number one, other than interest on debt, and maybe the number one biggest deduction that people think about in terms of real estate. So with depreciation, depreciable property does not include land, it includes buildings. So you'll oftentimes find, or you'll always find, an allocation of purchase price to buildings and to land. The amount allocated to the non-raw land is the amount that's going to be depreciable. The depreciation methods include acres, accelerated cost recovery system, which was enacted in 1981, and it's effective for tax years up until 1986. For property placed in service, after that we have modified acres, makers. Now, under modified acres, there's no need to have to figure out a salvage value of property, to figure out, or even a useful life, because property is assigned a class life based on the type of property or a recovery period. And makers also assigns an applicable method, which is either 200% declining balance or 150% declining balance, an applicable recovery period, that's that class life. concept and an applicable convention. For example, how much in the first year in the year of disposition, how much depreciation is allocable to that year. Most real estate is 27.5, 31.5, or 39-year property. Improvements to real estate are 15 or 20-year property. Now, ATRA 2012, American Tax Relief Act of 2012, provided some changes and some additions to the rules reflecting depreciation on real estate, American Taxpayer Relief Act of 2012. First of all, it extended the ability of a real estate owner or a lessee to depreciate certain type of property over 15 years. That's qualified leasehold property, qualified retail improvement property, and as a perk to the restaurant industry, qualified restaurant property. The Act also extended what we call 50% first-year bonus depreciation, acquired and placed in service before January 1, 2014. What that does, that allows the taxpayer to write off 50% of a cost basis in year the property is placed in service. ATRA also, for years beginning in 2012 and 2013, allows a taxpayer to elect to deduct as an expense up to $500,000 of the cost of certain property placed in service during a year in a taxpayer's trade or business. Now, that's reduced dollar for dollar by the amount of Section 179 property placed in service during a year in excess of $2 million, okay? And it's generally limited to tangible personal property, but now may include up to $250,000 of qualified real property. So I know I said a mouthful there, so let me summarize. Here's what we have under the new tax rules. One, up to $250,000 of the cost of real property, depreciable qualified real property, may be expensed in the first year. Up to 50% of the remaining basis in qualified leasehold improvement property can be deducted in the first year, and whatever remaining basis in qualified real property there is can be depreciated over a 15-year recovery period. Those are the new rules under ATRA. Okay, credits. Again, this is an industry that has a subset that relies quite heavily on credits, and one of the things to keep in mind about credits is that they can be syndicated oftentimes, and we can create an entire financial product out of tax credit planning. So the one big one that you might hear about is the rehab credit, Section 47, under which taxpayers can take a credit for the portion of expenditures made in rehabilitating a qualified building. Now, it usually equals the sum of two amounts: 20% of qualified rehab expenditures with respect to a certified historic building, and the second amount is 10% of the qualified rehab expenditures with respect to other qualified rehabilitated buildings. And those amounts were increased between 2006 and 2011. But that's the qualified rehab credit, 20%, 10%. Low-income housing credits, that is generally going to be the applicable percentage of qualified basis of qualified low-income housing. Let me tell you what I mean by that. It's a federal tax credit equal up to a percentage, and it could be up to 70% of the present value, depending on the credit type, of the cost incurred for developing low-income units in a rental housing project. Now, these credits can be syndicated, and typically investors will invest in entities, LLCs, for example, or partnerships, basically just to get the credits, because that's what makes these things work as an economic deal. And the credits are taken over 10 years. Again, up to 70% of the basis in the property. So you can see what a huge benefit that is. Big industry and low-income housing credits. A couple of other credits that touch or affect the real estate industry: disabled access credit, 50% up to of expenditures for disabled access facilities up to $10,250, and those are expenditures in excess of $250. New markets credit. This is interesting. Community development entities can sell credits to investors who invest in low-income businesses, and that includes real estate. So there are potential credits, new markets credits, and of course empowerment zone and energy credits, which generally can touch real estate. We've talked about deductions, we've talked about credits. Let's talk a little bit about limitations on deductions and credits. And the two that we hear most often in the real estate world are passive activity loss and at-risk limitations. So at risk, the concept is that amounts that are deductible are limited to the amount that the taxpayer has at risk, okay? So, and by at risk, what we mean is that the taxpayer is personally liable for repayment. General concept in the tax law when we have deductions. In the case of real estate, we have a big exception, and that is that a taxpayer share of qualified non-recourse financing is treated as at risk. Now, oftentimes in real estate, the financing will be on a non-recourse basis, meaning that the taxpayer has no personal liability for repayment of debt. The obligation to repay is limited to the property itself. So the creditor can foreclose on the property, but they can't go after the taxpayer generally. That would normally not be an at-risk amount because the taxpayer is not personally liable. So if that debt happens to be qualified non-recourse financing, then the taxpayer can take deductions attributable to the debt even though they have no personal obligation. What's qualified non-recourse financing? It's financing that's secured by realty. It's borrowed with respect to real property from a qualified lender. That generally means a bank. There's no taxpayer guarantees of the real estate, and it cannot be convertible debt. That's qualified non-recourse financing. Passive activity limitations. So the second and probably more significant and more prominent limitation on losses and deductions in the real estate world is the concept of passive activity losses. Now, typically, when we see losses from an activity, the first thing we do is group them into one of three categories. One is an investment loss. The other is investment gains or losses. Second is active income or loss. And third is passive income or loss. And we net within those three categories. So oftentimes in investment in property, if it's passive, we can only offset those passive losses against passive activity income. So the passive activity loss limitations apply to individuals, states, trusts, closely held C corporations, and personal holding companies. And a passive activity is a trade or business in which the taxpayer does not materially participate. Now, this concept of material participation is very important in passive activity land because it means regular, continuous, and substantial participation. And there are several tests, numerical tests, bright line rules that can be used to determine whether a person materially participates. The one you're probably most familiar with is the test that a person has to put in more than 500 hours a year in an activity. With regard to real estate, however, there are a couple of special rules. Number one, a rental activity is deemed to be passive unless one of a couple of exceptions applies, unless a real property business exception applies. And this means that more than half of a taxpayer's personal services are performed in trades or businesses, real estate, real property trades or businesses in which the taxpayer materially participates. Secondly, the taxpayer has to perform more than 750 hours of service during the tax year in real property trades or businesses in which the taxpayer materially participates. So to boil that down, what that generally means is that the person, real estate related losses are going to be passive unless the taxpayer is a real estate professional. In other words, unless that is their business, their 750-hour-a-year business. So think about real estate brokers, for example. Think about property managers, developers. They're accepted from this rule that rental activities are passive. Secondly, there is the concept of rental real estate active participation. And this applies to natural persons, and basically the passive activity loss limitation does not apply to the portion of a natural person's passive loss attributable to its real estate rental activities to which they actively participate during the tax year. This is the one that's most often used. So there has to be active participation. It's a natural person. However, this exception only applies to up to $25,000 a year of passive loss and passive credit deduction equivalent, and it is reduced by 50% of the amount of income of that taxpayer over $100,000. There's no hours requirement, there's just a management activity requirement to actively participate. But given these limitations, you can see how that would be a somewhat limited use in the commercial real estate world. So the one that we're really concerned about is the real property business exception, the professional real estate person. Moving quickly to leases, let me just say a few things about leases. With regard to rents, as you might expect, rents to the lessor are ordinary income, rents to the lessee are typically ordinary deduction. The definition of rents is normally pretty straightforward. Sometimes it's less so. For example, when a lessee pays a landlord's costs, that can be disguised rent or deemed rent. Advance rentals, for example, are taxable when received by the lessor. Reimbursements may be taxable as rent. The fair market value of leasehold improvements may be taxable as rent to the lessor when it's intended to be a substitute for rent. And this is an intention test primarily. The one thing I'd like to mention in particular about rents and the timing of the deduction on the lessee side and the timing of the income on the lessor side is the idea of backloaded or front-loaded rental agreements. Now, under Code Section 467, whenever there is a lease of tangible property, which includes real estate, Code Section 467 basically puts the parties on an accrual basis and imputes interest in the case of backloaded leases. So if we have prepaid or deferred rents, in other words, if we have increasing or decreasing rents in a lease, we have to be concerned with Section 467. 467 applies whenever there's more than $250,000 in total, and it applies whenever you have, potentially applies whenever you have increasing rents or decreasing rents, and it'll basically provide for a level amount of rental deduction and income, ratably plus an interest charge. So it ends the game that used to be played about having syndicating leases, backloading or front-loading some rent, and the playing off the time value of money because of the way the rents, and the deduction, of course, because of the way the rents were structured. Leasehold improvements. Typically, when an improvement is made, if a lessee makes the leasehold improvement, they just deduct the cost of that improvement over the shorter of the maker's depreciation recovery period or the lease term. Lease acquisition costs, this is sort of interesting because there is almost always lease acquisition costs. There may be bonus rent, for example. There may be brokerage. There may be fees. Typically added to the lessee's basis in the lease and amortized over the term of that lease. Same rule for the lessor. Add it to the basis in the lease and amortizable over the term of the lease if they end up having to pay these sorts of costs. So it doesn't, you don't often get an immediate deduction for those sorts of costs. Okay. By the way, before we leave leases, I do want to mention that you're familiar with the television show Extreme Makeover. There's an IRS private ruling in which the taxpayer attempted to exclude the, there's a rule that if a person rents a dwelling unit rents a dwelling unit, they can exclude from income the amount of rents for up to 14 days, so the number if the dwelling unit's rented. And the taxpayer in that case tried to exclude $50,000 worth of rent for 10 days under this exclusion. And you know, because according to the producers, you know, the Section 282AG would have allowed that exclusion because it was rented for less than 15 days during a year. By the way, taxpayer lost. IRS said that to the extent the value exceeded fair market value, was really a prize or award, and did not apply to this 14-day rule. So kind of an interesting thing that's come up recently in the rental world. All right, financing. So oftentimes in real estate, we have to make a distinction because the tax consequences are pretty dramatic between a financing transaction and a sale. Now, as you might expect, with the mortgage financing, the debt proceeds are not taxable, even if they end up in the pocket of the borrower, because there's an obligation to repay those proceeds. If we have a deemed sale instead of a financing, well, then those proceeds would be taxable. So there is a tax significance to financing versus sale treatment. Mortgage acquisition costs, just as an aside, are typically capitalized in basis and amortized over the life of the loan. Points can be fees and capitalized the same way, or they can be interest. It's really a factual determination. But what I really want to talk about, having given you part of the tax stakes for mortgage versus sale, are some of the more creative financing structures that are out there. For example, synthetic leases. Now, you may have heard this term more in the past than currently, but the concept behind a synthetic lease is a lease that was treated as a true lease for GAAP, for accounting purposes, and usually had a very low rent. So for accounting, there would be a small rental expense, but for tax purposes, it was treated as a financing transaction. So those rent payments were treated as debt service payments, and the taxpayer lessee, I guess, would claim ownership and take a big depreciation deduction. So you get a much better tax result. We also refer to those as off-balance sheet leases. More common is the issue of an operating lease versus a capital lease, and you see this often in the sale-leaseback world. Do we have a sale or do we have a financing device? So let me just summarize the consequences between it. So number one, is the lease an operating lease, a true lease, or is it a capital lease, a financing device? Sort of depends on the facts. A mortgage or a capital transaction, a mortgage as opposed to a lease or sale, is often characterized by net lease terms, a scenario where the seller lessee in a sale-leaseback gets the appreciation of the property if we have a low market rent, or if there's an option to buy out at the present value of the rent payments. That sounds a lot like a mortgage, doesn't it? Those are some facts that might indicate a sale as opposed to a mortgage. So once we determine which we have, an operating lease versus a capital lease, here are the tax stakes. And by the way, the transaction is seller sells a property to buyer and then leases it back. So buyer makes a payment to seller, seller then makes rent payments back to buyer, okay? In a capital lease, if it's truly a capital lease, the depreciation is going to rest with the seller lessee, because it's just a financing transaction. All they've done is borrow money. The rent payments are really treated as loan amortization payments. There's an interest element in that that'll be deductible, but otherwise not. And the proceeds that they receive from the buyer is really just loan proceeds. If it's an operating lease, the depreciation is going to rest with the buyer, right? Because we've really sold it, and now the buyer owns it and takes depreciation, meaning that the rent that the seller lessee pays to the buyer is going to be treated as rent, deductible on the pay side, income on the receipt side. And of course, the proceeds, if there were any, would be taxable to the seller lessee as sales proceeds. Those are the tax stakes, and there is some flexibility in structuring transactions to fit within which tax category we desire. The case law has been somewhat contradictory, haphazard, and a little bit optics driven if you read enough of these cases, but we do have some guidance, and we can get some, and there are some economic factors that can give us some comfort on which of these two categories we fit within. A couple words about tax exempts, because this is a gotcha. So number one, the sale lease back with the tax exempt. Just keep in mind that if real property is sold to tax exempt and then leased back to the seller, the tax exempt itself may end up with unrelated business taxable income on a portion of the net rental income, and it has to do with whether it exceeds its average acquisition indebtedness of the property. And you can see what the tax code is getting at here. We got a tax exempt. This, we're worried that we're really leveraging the tax exempt status to lower the overall effective tax rate. That's number one. The more common scenario, however, has to do with the concept of tax-exempt use property. Now, there's a concern that there's a potential for abuse whenever you use a leasing transaction to allocate economic benefits and burdens among parties, including a tax-exempt entity. So, tax-exempt use property, and this is property leased to a tax-exempt, okay, is property leased to a tax-exempt. It's subject to special rules, includes non-residential real property in certain cases. And if we do have a lease to a tax-exempt, so we have tax-exempt use property, the tax code is going to put that property on 40-year straight-line depreciation, and it is going to suspend any losses from the transaction, all right, until exit. So when does this apply? Well, it applies if one or more of these conditions are met. So the property is financed with tax-exempt bonds. It applies if the lease has a fixed purchase option on behalf of the lessee. It applies if the lease term exceeds 20 years, and it applies if the lease follows a sale of the property by the tax-exempt, so sale leaseback scenario. If we have that scenario, we have tax-exempt use property, we're limited in terms of depreciation, deductions, and losses are suspended. Distressed property. We have done an entire hour on distressed property and the tax consequences around that, and we certainly could talk a lot about that. I want to hit a couple of the high points because from time to time you will have distressed property issues. First of all, it's a concept of cancellation of indebtedness income under Code Section 108. So the general rule is whenever debt is reduced, you go back to the lender and you say, please reduce the debt, forgive some of the debt. We have income equal to the amount of the forgiven debt. That's the general rule. Now let's talk about all of the permutations and exceptions. Number one, if we have a transfer of property back to a debtor in exchange for debt, we may have cancellation of debt income, or we may have taxable gain, which may be capital. So how do we make that determination? Well, number one, is it recourse or non-recourse debt? If we have a transfer of property in exchange for recourse debt, we have cancellation of debt income to the extent that the debt exceeds the fair market value of the property, and gain otherwise. If we have a transfer of property in exchange for a non-recourse debt, we have sale gain for the entire amount. Suppose instead of a transfer and foreclosure or in deed in lieu scenario, we have simply a reduction in debt. The value of the property's gone down. You go back to the lender and say, look, so you don't have to foreclose on me, how about we just write the debt down? And that's where this exception for qualified real property indebtedness applies. Now, if it is qualified real property indebtedness, we do not have cancellation of debt. We exclude the reduction in the debt from COD income down to the extent of the fair market value of the property. So in other words, we can write debt down to fair market value, not have any COD income, we just reduce basis. But to the extent we write the debt down below the fair market value of the property, we do have COD income. That's qualified real property indebtedness exception. What's qualified real property indebtedness? Well, basically, it's debt incurred or assumed to acquire, construct, or improve real property used in a trade or business and secures the debt. General rule. And you can think of it as a purchase price adjustment. Other exceptions, of course, debt discharged in bankruptcy is an exception to COD income, although we do have to reduce attributes. There is an exception for debt discharged that is qualified farm indebtedness. And there's an exception that we won't talk about here because it's not commercial, but qualified principal residence indebtedness that sometimes applies. The one that's most often used, if not qualified real property business indebtedness, is the insolvency exception, meaning that we just reduce attributes and we don't pick up debt to the extent that a taxpayer is insolvent. And that, of course, applies typically at the individual level in the partnership scenario. Foreign ownership. We have done an entire hour on the tax issues with respect to foreign investment in U.S. real property. But I'm only going to spend a few minutes on it here and hit a couple of the high points. So whenever there's foreign investment in real property, one of we really have to consider these three major tax issues. And let's start with withholding taxes. Typically, rents on U.S. property, that's U.S. source income, paid to a foreigner is subject to a 30% rate of withholding, or a treaty rate if it's less and the foreigner is a resident of a country with which the United States has an income tax treaty. It's based on the gross amount of the rents, and it can be a very high amount. However, there's an election that a foreigner investing in real property can make to treat it as business income or effectively connected income and pay tax on a net basis. And we remember what our current tax rates are on a net basis, right? It's up to 39% individual, 35% corporate. All right, there is also this little subtlety that if the foreigner is a foreign corporation investing in U.S. real property, they not only pay the graduated rates on the income, they pay branch profits tax at whatever, usually what the dividend withholding rate is on the amounts repatriated from the U.S. back to the foreigner. So it's almost as if the same as if the foreign corporation organized a domestic corporation, or it should be the same as a tax matter as if they organized a domestic corporation to make the investment. So withholding taxes have to first be considered with inbound foreign investment. Probably even before we get there, as a structuring and planning matter, we need to think about FIRPTA, Foreign Investment in Real Property Tax Act. Now, what FIRPTA is concerned with is not so much the operations of the real estate activity as much as the disposition of the real estate. And FIRPTA imposes a 10% federal tax withholding obligation on the gross proceeds from the disposition of a U.S. real property interest held by a foreigner. By the way, here in California, we have CalFIRPTA, which imposes another 3 1/3% tax on the proceeds of that disposition. So if you're a smart foreigner, you might decide, well, I know how to get out of that rule. I'll just drop the property into a U.S. corporation and I'll sell the stock of the U.S. corporation. Nice try. But under FIRPTA, the sale of stock of a U.S. real property holding corporation is also subject to FIRPTA withholding. And a U.S. property real holding or U.S. real property holding corporation includes a U.S. corporation whose U.S. real property interests equal or exceed 50% of the total value of its assets. The one big gaping exception here, where it doesn't apply, is when we have a foreign corporation. So a foreigner can drop the property into a foreign corporation, sell the stock of the foreign corporation, and generally avoid FIRPTA. There's a special election to be subject to it, but I can't imagine why anyone would ever make that. So sale of foreign corporation, you avoid it, and it's the foreign corporation's problem to deal with down the road. Sale of domestic corporation, FIRPTA withholding applies. Now, there's an interesting choice of entity issue that comes up, especially now that we have a disparity between corporate and individual tax rates in the U.S. So keep in mind that a corporation that owns real estate and sells real estate doesn't get a capital gains exception. It's going to pay tax at 35% potentially on its gain. An individual will pay tax at 15 or 20% depending on income. So you can see there's a big disparity. So an individual investing in the U.S., even a foreigner, might be well advised to invest directly and not through a corporation just like a domestic person. That, however, subjects that foreigner to potential estate and gift taxes on a disposition of the real property. It requires them to get into the U.S. system for purposes of paying and reporting taxes, and that is oftentimes enough of an issue to get people to simply accept the higher tax rates. But it does raise an interesting choice of entity issue with respect to foreigners. Okay, and what makes it, I guess, a little bit tougher decision these days is the fact that the individual rate has gone up to 39. So instead of having the exact same rate, top rate as a corporation on the annual earnings and income of the real estate, if indeed there are any, there's now a disparity where the corporation is going to get a little bit better rate, which may tip the scales in favor of using corporations for inbound investment, which is what I think we typically do most of the time because of these issues. even though you can see there's a big tax benefit to owning individually on the back end. A couple words about information reporting that real estate professionals should be aware of. Real estate broker reporting. So there's an information return, 1099, and customer statement that's required to be given in a real estate sale transaction. The regs have an order of priority as to whose responsibility it is. It's first the title company. If the title company doesn't do it, it's the lenders, not the lender, the seller's broker, and the buyer's broker, and then the trustee if there's a trustee involved. But it does have to be given. FIRPTA reporting, we talked about FIRPTA withholding. There's also a reporting. Form 8288 gets submitted with the tax by the buyer. Mortgage interest reporting. The recipient of interest provides an information return and a payor statement. It's anybody who is engaged in that trade or business and receives interest in the course of that trade or business. It's Form 1098 with a 1096 transmittal. There used to be a reporting requirement for any recipient of more than $600 of rental income. That's been repealed. And whenever you have a foreign transaction these days, or a foreign bank account, or an entity, a foreign entity that has U.S. members, we have to be concerned about Form 8938, U.S. taxpayers with specified foreign financial assets, or reporting by foreign financial institutions with respect to U.S. taxpayers or foreign entities in which the U.S. owners have a substantial interest. Not really specific to real estate, but it's big news in the tax world, and I mention it whenever I can. A couple of other things. Towards the end here, I just want to mention the idea of syndicated TIC investments. We talked about 1031 transactions. Keep in mind that there's a thought that there is an economy of scale whenever investors can get together and engage in much larger transactions, and that has given rise to this industry of pooling 1031 investment and investing in tenancy and common transactions. Again, I have done a whole hour on this topic. Oftentimes you see them as tenancy commons right here. More often these days you see one Delaware business trust that consolidates everything. The tax tension here is to make sure that the co-ownership or TIC agreement is not a deemed partnership agreement. And there are extensive rulings and regulations that set forth criteria that must be complied with in order to avoid that characterization as a partnership. Because if it is a partnership, then you don't have an exchange of like-kind property. You have an exchange of partnership interests, which cannot be like-kind. And there's the Delaware statutory trust that I mentioned that are oftentimes used these days in syndicated TIC deals. We've talked about recent developments in tax rates, so I won't dwell on that. And we've also gone through some of the pooled investment vehicles. I just want to pause and just tell you that in the market, smaller real estate investments are often used with IRAs. It's very commonly done. Again, there are very specific rules with respect to prohibited transactions with disqualified individuals that must be complied with, but much of the investment in real estate in the U.S. is being done through IRAs these days, and it's something for people to be aware of. With that, I see that we are out of time. I, again, want to let you know that we've certainly covered a ton of ground today on taxation of real estate. This is going to be recorded. There will be a transcript available and slides on our website at royceuniversity.com. And I thank you for your attention.